understand that we also connect involve to the live of this Facebook individual who also can post question in this comments column. For those joining via the Zoom, definitely you can post question in this Q&A as well as the chat as well, right? Now, of course, we talk about a little bit of Jay. Now, indeed, Jay, I think in the year of, as you can see in the slide, I think this year will be stepping into 16 years into this financial stockbroking business. Now, he joined in Philip Security, I think, as a stockbroker, and then after that, he immediately for 2-3 years taking a dual license. Now, in fact, for the last 3 years, he's taking a much higher role as a wealth manager, taking care of, I think, as of now, should be more than $3 million to $4 million in some of the asset under management under his care, right? So, indeed, Jay believing using both technical analysis as well as the fundamental analysis to form his market insight. This is something that not many speakers and trainers in Singapore using this unique both TA and FA to form his market insight. And indeed, Jay is also using some form of the financial behavioral financial to share with you in fact for today 2-hour session as well, right? So please stay tuned to the end of session. Like I said, myself and Jay going to share you. Definitely you have a good to take away for to this afternoon webinar session, right? So please do post your question. If you do have any question during the live webinar session, post it into the chat or Q&A. As well for those who join in via Facebook Live, please post your question in the comments column, and my colleagues can provide the reply, right? So without much delay, I shall cordially invite Jay to take over the mic from here. Jay, please.
Yes, thank you, Andy, for introduction. A very good afternoon to everyone. Thank you for joining me during your lunchtime. And I hope that you'll be fruitful, not just having a lunch, but also be fruitful in knowing what to deal with, especially in this second half of 2023. Now, why do I want to talk about this topic about second half of 2023? It's very simple. Because every half of a year, what I do is that I'm going to share review, and I'm going to share my opinion about what is the strategy for the coming second half of 2023. And generally, when I share, it's also where I also do my research and also to prepare the information for everyone to understand. So in today's session, I'll be sharing my expert knowledge on how the market is going to be roughly moving. And all these are really based on my years of experience, like Andy has shared earlier on. And there is certainly a pattern, a way to analyze the market over time. But sad to say, over this one to 2 hours of a session, it's really very hard for me to share very deep into detail on how to handle individual things. But what is more important is that I want to train everyone, every individual to be able to analyze and also make their own investment decision. Ultimately, is to teach everyone to know how to make their investment work for them. Instead of the other way around, attending different talks, trying to understand so many different things, in the end, you get very confused and very hard to make an investment decision. So that's where making investment work, I have designed this course in a way that I want to train every individual to be able to make their own investment work for them instead of being the other way around. So I'm very thankful that this course is being accredited by IBF, Institution of Banking and Finance, because with IBF accreditation, this marks that whatever I'm training and teaching is not just based on my personal experience only, but it's also based on what the professional really need to be a professional in the market itself. So I have a lot of opportunity to train a lot of financial practitioners in the market, not just within Philip Capital itself, but also in other financial institutions. So rest be assured, when you go through for making investment training, what you are learning is not just based on individual experience, but it's what the market practitioners are practicing. So before I want to start on today's topic, talking about second half of 2023, I think it's really important for me to share some simple disclaimer and limitation of the talk today. First of all, I'll be focusing on Singapore market per se, because majority of us are Singaporeans and we invest in the Singapore stock market itself. Furthermore, it's closer to our heart, and more information is something that is more relatable comparing to other countries. So do take note that I will be using a lot of past performance indicators or data or informations, and this may not be the best indication of the future performance, because as far as possible, when new informations are out, that's where we have to adjust according to our analytical positions. So please do take note that as far as possible, I'll be using as latest data as possible to share with everyone. In time when there's need, I'll also share some new information. And do also consider your own personal risk appetite, because whatever I share today is based on my personal opinion and also based on my personal risk assessment. But rest be assured that I will be my risk level is a very I deem myself as a very cautious person. I do not like to take risks, but please do also consult your own financial practitioners or financial planners or advisors to discuss with them, because they will understand your risk the best before you make any investment decision. Lastly, I pride myself as an investor. I surely and certainly at our point in time will have invested position into Singapore market especially. So today's session is not a session for me to recommend any individual stocks, but as a general perspective to help you to understand where the general market direction will be going. So this is not a talk for me to stimulate the market or to increase any buying interest or selling interest in any positions in the market. So please do take note of this. Here, what is my main purpose here is to help you all to understand how to analyze the market direction by yourself. That is always my objective whenever I train my students in making investment work or other courses. Okay, so with this, I also want to encourage everyone to make use of the Q&A function in this Zoom meeting chat, in Zoom meeting, so that you can ask me questions, you can chat with me, because whatever I prepare is really based on the information, based on my personal knowledge. Sometimes, very interestingly, there are people who are listening in and say, hey, Jay, I have this idea, what do you think, and so on and so forth. So with such interaction, definitely you are going to benefit from more information or more of my personal opinion of where the market is going. So I do encourage everybody to make use of the Q&A function, and at appropriate time, I will be answering these questions and also to encourage you to ask me questions. Okay, so let us be started with today's topic. The key question, whenever I come to the second half of this, of every year, okay, not just this year, is that I want to understand at the second half of this year, where will the market be heading? Why? Because half year is the best mark for us to review back what had happened in the first year. And then is there anything I need to adjust to my overall strategy for this whole year? So what's my overall strategy for this whole year? To set context right, to set for everybody to understand, because some of you has been coming in since January to listen in to me about my whole market opinions every month. So as a context to help those who are new, thank you for joining me in today's session. I want to help you to have the right baseline to understand my perspective before we move on to talk about the second half of this year. Now, in early this year, in the month of January, I'll talk about what to expect in the whole year of 2023. In short, in very simple sense, what I expect is that the first half of this year is going to be a very, very volatile year. And in this very volatile first half of this year, what my strategy is to think about resetting my portfolio. Resetting means that I'll be looking out for shares to take profit or even to cut loss, so that I have more cash on hand to be ready for investment opportunity. So first half of year, this is my expectation. And later on, I'm going to share with you what had happened in STI and whether STI has met my expectation. Okay, the movement in the market has met my expectation. After which, of course, the second half of the year, I expected that the second half of the year, the market will be calmer, will be less volatile. And in a more calm market situation, this is the best time for us to look for opportunities to start to invest in. Why? because it will bring more certainty, it will bring more clearer direction in the market. So second half of market is where I call it the restart strategy, where I restart my portfolio, whatever I have sold off earlier on this year, the cash that I have, must be ready in this second half to start to look for investment opportunity to buy into the market. And that will be the best timing. So that's my general understanding, and that's my general strategy and perspective when I start off for this whole year. So as you can see, this is how for me as a wealth manager of handling more than 2 over million, 3 over million worth of portfolio, how I give a general direction of the market so that I can prepare and watch and strategize what to do for the whole year. So with that understanding, with that context as a baseline, let us look through what had happened in the first half of this year. And through, if there is certain level of accuracy in the first half of this year, then we can be ready, or you can be excited of what is likely to happen in the second half of this year. After which, then I will talk about what is the fine-tuned expectation of second half of this year by looking at the current market movement, current market sentiment, and through understanding of market sentiment, how are we going to derive our general direction based on fundamental analysis. So that will be a structure for today's session, and I'm going to share, of course, at the end of the session, I'm going to share what is the things that I'm looking at, what's the general opportunities or even risks that we should be looking at. And also I want to encourage everybody to stay until the end, where I'm going to share more into details of the special course I'm making for this year, because the second half of this year, I believe, is a year of restart. I got a lot of exciting things that I want to introduce, especially for those who have attended making investment course. So let's see. The first half of this year, okay, the first half of this year is where the market looks like this. This is an example, not example. This is the direct chart of STI over the first half of this year. And in the first half of this year, you'll see the STI hit a high of 3,400 level before it start crashing towards 3,100 level there about. And if you look at the whole first half, it is indeed true. The market goes up and down in a very sharp manner. Okay, so it shows a very volatile first half. And this shows that, hey, whatever I shared earlier on this year, there's a certain sense that, hey, there is a certain sense of accuracy. How come I know? It's because in the first half of this year, on January, I also share about the fundamental issues and things that are happening in the market that can cause such volatility. And in fact, in the first half of this year, did the market really perform very well? The answer is no, because the market only performed down by 45 points, meaning down by 1.4%. Market is not really moving up or not really moving down, but it's going in a very sideways fashion. But while moving in a sideways fashion, the volatility is so high, causing the market to fluctuate up and down so drastically. But as you can see from the chart itself, it seems that the market now is starting to stabilize a little bit. But how do we know going forward if it stabilizes a little bit? Is it stabilizing towards going downwards, or is it stabilizing towards going upwards? So this is where what I'm going to introduce now is to help you to understand how to prepare yourself for second half. Although I have a general direction that second half of this year is going to be more calm, like what you roughly see in the chart just now. But how do we have a stronger sense of the direction for this second half of 2023? So what I do is that I will observe two things. The first thing I want to observe is to observe the market sentiment. The sentiment, is it now switching towards more positive sentiment? People are more positive of market, thinking that the market is less risky and is worth it to invest in, and this usually cause the share price to go up. Or do they expect bad news coming? Or do they expect things are not going to do well in future? So therefore, they liquidate a position and exit the market, causing the price to go on lower side. So that is what market sentiment is about. And the underlying of all market sentiment, the triggering point of all market sentiment depends on the economic performance of a specific country. I call it the economic numbers. So later on, I'm going to share with you what is the expected economic numbers that are coming up, or what are the latest economic numbers that is being derived to give us an understanding of where the market will be running, moving towards going forward. So when we study these two things, the market sentiment and economic numbers, is basically just a study of technical analysis, where technical analysis study how price move, okay, how prices move, and technical analysis can help us to understand the market sentiment. And when we study the economic numbers, it's a study of fundamental analysis, how company perform, how the economy performs itself. So there are basically these two schools of thought, like what Andy has introduced to you guys, that I'm one of the unique practitioners in the market with which I both combine fundamental analysis and technical analysis to derive my point of view in the market. Why I want to combine both? I also want to justify and prove to everyone that it's related. Both of these analytical methods, we need to use both of them. So over here, I have the chart of the GDP. GDP stands for Gross Domestic Product. To measure a country's economic performance, we look at GDP number. The higher the GDP number, the stronger the productivity level of the country is. So when there's a stronger productivity, this also translates to possibility of higher profit generated from individual companies. So that is where the relationship between the stock market performance with the GDP performance. But another relationship that we can use GDP to help us to understand is to look at period where the economy slowed down. So over here, you will see these are for the past 20 years, these are the 3 periods where Singapore experienced economy slowdown. Okay, in the year 2008, 2009, okay, and where the Lehman Brothers crisis happened. Then the 2014, 2015 period where there's another what I call the China crisis that happened. And then in 2019-20, that's where the COVID-19 crisis, where Singapore experienced a lockdown. And of course, the lockdown period is the greatest drop in economic activity in Singapore. But going forward, the next key is that we also need to know going forward. If you are going to see the GDP number is going to expected to be going up, probably it can translate towards that the stock market can continue to perform well. So when stock market can continue to perform well, share prices will generally go up. But over here, the numbers I have on this chart are based on estimates. Okay, estimates are indication that there is a possibility in growth, especially in 2003. But I'm afraid to say these are estimates. There's no clear concrete numbers. The concrete numbers later on, I'm going to share with you the clear concrete numbers that is derived. Okay, but how does this going to show that GDP number is going to impact on the stock market performance? That's where I want to overlay the performance of GDP numbers over the performance of the Straits Times Index. So when I overlay this performance number year to year, okay, year to year, you can see there is certain level of correlationship. For example, in early year 2004 to 2007, you see as the GDP number grow, okay, as the GDP number grow, you see a stock market prices go up. But the gradient, if you observe the gradient of the line or gradient of the movement of stock market, it seems that in year 2004 to 2007, the rate of growth in a stock market is really very fast. Okay, it has grown very fast, despite that the GDP growth is not so fast. But after that, when the Lehman Brothers crisis occurred, you will see that the stock market prices drop very, very drastically. Okay, could be an adjustment for the sharp growth that we experienced in 2007 to 2004 to 7 in the STI. Okay, but when we look at the economic numbers, the economic numbers seems to be not performing well. It's not as sharp as expected. So what happened during this period is that the market actually adjusted to the reality. So that's why whenever the GDP number is not growing, the stock market will have reaction. So similarly, after which you will see that as the GDP continue to grow again, you see the stock market prices also have a tendency to rise up itself. And the pattern repeats again. Whenever the GDP numbers slow down or drop, you see the stock market prices will also adjust accordingly. But this time around, the adjustment is not great because the stock market prices did not rise up very fast. And as you look forward in the years 2016 onwards, you see whenever the GDP numbers goes up, the stock market prices will go up. So all these for the past 10 years has been quite reasonable in terms of movement. It's not a very drastic movement. However, the biggest impact that we have experienced in the stock market recently is the surprise virus that has infected the whole world in year 2019, end of 2019 to year 2020, where the COVID-19 strike, where the circuit breaker we have experienced strike. This has caused the stock market prices to drop very drastically. And also the economic performance of Singapore also dropped very sharply. So do you see this repeating pattern? Do you see the relationship between stock market share prices with the economic performance? There is a correlationship. And since there is a correlationship, we can rely on such correlationship to help us to prepare and anticipate what is coming forward. So like, for example, ever since the pandemic has ended, kind of become an endemic, Singapore stock market has been rising towards 3,300, around 3,300, 400 level. And the economic numbers are also rising based on the estimate I showed earlier on. But the concern right now is that, okay, how are we going to compare these two things? Is it the economy is going to go higher? If the economy is going to go higher, then we can expect the market share prices to be going higher in future. Or am I wrong? Is the drop in economic activity going to happen? Or if it's the economic activity is going to drop further, then we should expect share prices to drop further. So that's where at the second part, I'm going to explore deeper to talk about the market sentiment first. Right now, I'm going to pause here for a short moment for a quick water break. And if you have any questions, please feel free to use the Q&A function to ask me questions. And I also use this time to share with you my opinion. Okay, so if you have questions, please continue to type and I'll also answer your question at appropriate time. Okay, let's continue. So now let's start off with looking at the market sentiment. When we talk about market sentiment, it's all about recognizing repeating patterns. Like earlier on, I saw a pattern between GDP economic numbers with the Straits Times Index movements. So it's about studying of repeating pattern. Once we understand once we recognize the repeating pattern, then we'll be able and it will be easy for us to identify whether the market is going to go up or whether the market has bottomed and is it going to whether the market is going to go down further. So today I'm going to introduce to you two patterns. The downtrend pattern, when the market goes in downtrend, how does it going to look like? And the market bottom, because when a market hits a bottom, means that this is going to be a good time for us to start buying and we buy, what we experience later is an upside movement in the market. So by looking at the past, it's all about looking at past pattern. In 2007, 2015, and even the COVID crisis, it shows a very sharp downtrend. Okay, like earlier on when the economic numbers are not doing well, you see a very strong downtrend. But what I observe in downtrend pattern is like this. Like in 2007, the downtrend movement before it start to form a market bottom, it looks like this. I call this the 1, 2, 3 downward movement. 1, 2, 3 downward movement. And if I repeat this and look at 2015, you notice that 2015 also have this 1, 2, 3 downward movement. And even in the COVID crisis, it also moved in a similar way. So whenever a 1, 2, 3 downtrend pattern happens, a market can form a market bottom. But to conclude whether the market form a market bottom, that's where we need to learn how to identify the bottom pattern. So ever since 2001 or year 2001 to 2004, I've noticed that whenever a market forms a bottom, it will have this shape. It's not 1, 2, 3 shape, but it is a W shape. And after a downtrend pattern that is happening in year 2008, it also start to form a similar bottom, a W-shaped bottom. That's very interesting, right? And when you go up to the next crisis in 2015 and 16, it also shows something very similar, like a W shape. So what I can conclude is that whenever the market forms a downtrend, and right after the 1, 2, 3 downtrend pattern, I must get ready for the market to form a W-shaped bottom. So with this observation, with this confidence of looking at repeat pattern over the years, during the COVID-19 crisis, at the bottom in year 2020, I start to see a pattern in year 2020. Do you notice a W-shaped downtrend pattern that had happened over here? Go down, go up, go down, and then go up again. So with this repeating pattern, it can give you confidence and it can give you understanding where the market is going forward. So what had happened after this downtrend pattern is that the market start to form a bottom. After forming a bottom, it start to go up. But right now, the problem with the market right now that brings a lot of uncertainty is that since second half of last year to the first half of this year, the market is not behaving the way or like an uptrend that is going upwards higher and higher. Instead, it seems to be stuck in a sideways movement. So when a market goes in a sideways, it brings a lot of uncertainty. Even practitioner like me who look at chart, I cannot identify where the market will be going. Whenever the market goes into a sideways, there's only two possibilities. Either after the sideways, the market will be going up or it will be going downwards. But let me address the main concern that many participants in the market is having right now. Many of us are naturally fearful of losses. One of the behavioral biasness that we have is that we want to avoid losses. So everybody are very worried that the market may turn into a downtrend. So with the knowledge of how downtrend looks like, we can apply it over here. So if the market goes in downtrend afterwards, especially in this second half of this year, how will it look like? So let me share with you that probably what had happened in early this year, if it's going to be a 1, 2, 3 pattern, the early drop in the early first quarter of this year could be 1. And then when you come to second quarter of this year, when the market rebound, it can be 2. And if it's 2, what we can expect later on is the market goes for the 3 movement. Once after hitting the 3 movement, then that's where the market can likely to form a bottom. So if we form a bottom, is it going to be advantageous for us? Definitely yes. Means that second half this year, even the market goes for a 3 movement, it is coming to start a bottom pattern. So when you start a bottom pattern, means that it's actually an opportunity for us to look into buying into the market. So yet, what I'm trying to say is that second half of this year is going to be a market, second half of opportunities. That's how I can confidently share with everyone. But the concern is that, how do we know that going forward in second half of this year, at which point should trigger us to conclude that the market is going for the third movement, the third downward movement? So from the charts, we can establish some lines. We call it the support lines. The current support level for the Straits Time Index is at around 3,100 level. Meaning, if the market, that means the STI, goes lower than the previous low, which is around 3,100 level, if it goes below 3,100 level, we can firmly conclude that the market is going to go in downtrend, meaning it's going to go in the third phase of a downtrend, the third movement of a downtrend. So I always keep this level in mind, 3,100. If the market breaks 3,100 level, then I shouldn't be so eager in buying the market. So that is how I plan and how I anticipate using technical analysis to prepare myself the possibility of downside. But yet, if I know the possibility of downside, it doesn't mean that it's end of world. I cannot find any market buying opportunity. In fact, the lower the market goes, the cheaper prices that you can get in the market. So it's an opportunity whenever the market comes down. However, what is really, really tough is this. What if the market doesn't go down? What if the market chooses not to go below 3,100 level? Instead, what if it chooses to go up? That's the toughest part really now. Because if we anticipate for a downtrend, and if the market reverts and it refuses to form a downtrend and start to go up, we cannot hope for a cheaper price to buy anymore. If we don't buy, we probably could have missed out a lot more upside movement in the future. Okay, so if we miss the upside movement in future, then that's it. If you keep on anticipating it's going to buy lower price, when the price starts to move upwards, you could have already missed the opportunity. Especially as the price go higher, mentally you will think that I want to buy cheaper. I want to buy cheaper. The more cheaper you want to buy, the higher the share price goes, and the higher the share price goes, you start to feel regret, which is one of the financial behavior I teach in making investment course itself. So I always plan for 2 directions. What if the market goes up? At what level should we identify that it will not go down anymore? It will go up going forward. That's where this time around we'll be identifying the recent high level. If the market goes higher than recent high, which is at 3,320, I can straight away conclude that, okay, no point waiting for the market share price to go lower. In fact, what I'm anticipating going forward is the share price will be going up at a much higher level. So I should be learning how to chase the share price, not an exuberant price, but being enthusiastic in finding market opportunity again already. So remember these 2 key levels, 3,100 level and 3,320. Right now at current market condition, okay, last week or a week before, the market nearly break the 3,100 level, but instead it managed to sustain and now hovering towards 3,320. So I'm trying to say, hey, now we are still at the point of indecision, point of uncertainty where the market will be going. So how then we know where the market will be going forward? Whether is it going to go up or is it going to go down? How do we know what are the direction this second half of this year the market is going to undertake? So right now, the chart is not telling me 100% where the direction is. It's definitely uncertain. We are right smack in between. Don't know where the market is going. So how do I, then like that, if I use technical analysis, how does Jay tell people, how do I share my opinion where the market will be going? So this means that I cannot rely just solely on technical analysis because it's not giving me any story right now or any direction right now. Next, where I have to rely on the economic numbers. I have to rely on the fundamentals already. Why? Because fundamentals is the one that support the market direction. The underlying of market direction is the fundamentals of the market. So the key thing that we have to understand right now to derive a general direction for the upcoming second half of this year is to look at the economic numbers of Singapore. The main question I'm now asking, and I want everybody to think about, is Singapore economy growing? If Singapore economy is growing, then I can be certain that going forward, it will be supporting the stock market prices towards the upside. If the Singapore economy is not growing, then probably we'll have more possibility of downside movement. So this is where I'm going to share with you the fundamental information, what are the information I gathered, and from there, then I can derive a general sense and a general direction, what is the likelihood where the market will be going in the second half of this year. Okay, so here are the information that I have gathered. First of all, let's look at the general overall Singapore economy overview. What I have earlier on this year, okay, is the first quarter. That means during May, when I prepare for this slide, during May, it reported the first quarter of this year. Usually it's a lagging one. The information is lagging. Okay, because it takes time for the government to derive all the figures, all the numbers, and to conclude the numbers. So on the 26th May, it's being reported, actually it's on the 25th May, the papers report on 26th. On 25th May, it's been reported that Singapore is being expected to grow, but it's slowing down. And based on first quarter, it's only growing by 0.4%. Very little, okay? Thankfully, it didn't go into negative category, because if you go into negative category, there is a possibility of recession, okay? But when MTI reported this first quarter, they also share what's their expectation, okay? So they are forecasting that this year, 2023, GDP numbers to be around 0.5 to 2.5%. Okay, 0.5 to 2.5%. Why? Why are they confident about it? It's because of a few sectors. If you look at the sectors based on first quarter, how it has performed, the sectors or the industry that is growing is actually the accommodation and food and beverage services. Or in short, we can also say that these numbers or this growth comes from the tourism industry. So MTI has shared that the tourism industry has helped the Singapore economy to sustain and not go into the negative territory. But what is really dragging Singapore economy down is the manufacturing sector, okay? Because the manufacturing sector is down by 5.6%. So later on, I'll be specifically talking about these two industries to help you all to understand going forward, because this is based on first quarter. Going forward in second half of this year, what is the likelihood? What are the chances? Okay, but this is a bit of outdated data. This is based on 25th May information, but based on the latest data, we are now in the second half of this year. So what the MTI will usually do is that when you come to second half of the year, they will share some advanced estimates, okay, based on some estimated numbers. And recently, on the 15th July, 2 weeks ago, on the 15th July, okay, which is actually 14th July, it's been reported that Singapore has avoided technical recession, meaning it has avoided going into a negative territory. So in the first quarter is 0.4%. But this time round, instead of 0.4%, Singapore economic GDP numbers is growing by 0.7. So there is some improvement in the numbers. Okay, there are improvement in numbers. Why? Because at second quarter of this year, based on estimate, there is a slight growth, quarter-on-quarter growth of 0.3%. Okay, so reports have been reporting that Singapore avoiding any technical recession. Okay, full recession requires 3 consecutive quarter of down. So if it's just only one quarter down, you can say technically it's in recession. It's a technical recession. Okay, so whatever you see over here is based on estimate. The full actual data should come maybe 1 or 2 months later. Okay, which is expected to be around September then. End August, September that. But some key things I want to share everyone is that based on this report, based on the advanced estimate, MTI are still looking at the manufacturing industry because manufacturing industry is still weak and is still on the gloomy side. However, they are positive that the tourism industry is going to offset any risk within the manufacturing sector, and they are expecting tourism to have expansion, okay, to have expansion in terms of the arrival of tourists into Singapore. So because of this, they have maintained, okay, they have maintained the positiveness that their target of 0.5 to 2.5% growth for Singapore is still being maintained over there. In fact, they adjusted and they are confident that Singapore is not going to be in negative territory this year. So when it's not going to be in negative territory this year, it means that, okay, it could bring some positive support for Singapore economy itself. Okay. So looking at the latest numbers, based on the sectors, I'm going to share these estimated numbers that is retrieved from this second quarter 2023 recently. I'm going to share some insights of the numbers that I noticed. First of all, the MTI has shared that the tourism industry is going to be helping Singapore economy to stay afloat. It's true. Why? Because if you look at the accommodation, food and services real estate support, this is a sector that we look for when we measure the tourism industry. And by second quarter 23, you'll see the estimates that is still positive, 6.1. However, if you notice from Q1 and Q2, there is a slight drop. Why? Because of the high base that happened in the second quarter of 2022. But let's keep in mind, there may be a slight positive, start possibility that tourism industry for second quarter is not as growing as much as what we are thinking of. Okay. And manufacturing industry definitely has been dragging very clear down by 7.5 year-on-year comparison. So manufacturing sectors has been doing very well during the COVID season, but now after COVID seems to be contracting. So that's why you can see manufacturing related companies, they are not doing well, especially the electronic industry. Okay, electronic manufacturing industry, they are bringing down the whole Singapore economy, as quite a huge percentage of Singapore economy depends on manufacturing, especially the electronic manufacturing sector. And when we base on quarter on quarter, something interesting to look at is that the best growth from Q1 to Q2 is the wholesale and retail trade, transportation and storage. That means in Q1, you see it's a negative number. Suddenly, this sector has been performing well. In fact, it's the best among all the other industries. It has been doing well. And generally, it's been pushed up because of the retail trade. Okay, why retail trade? I can closely associate retail trade together with tourism industry itself. So later on, I'm going to share with you some retail numbers and to help you to understand going forward, whether the retail numbers is going to be better. So if it's better, means that the overall GDP for second half of this year is going to improve for certainly. So this is on the 15th July, I also see the article on the tourist arrival. Okay, just nice, in the same period. Okay, so the tourist arrival number has been very, very positive. It has been growing for 4 straight months. Okay, 4 straight months since January, where all the countries in the whole world, they are opening up borders. Some interesting information that are gathered also over here is that they have shown the top countries, top visitors of Singapore. And you'll notice the top visitor comparing in the chart at the bottom right-hand corner. Left-hand side, you will see that in 2019, January to December, that the top tourist arrival is actually the mainland China side, okay, which amount of the 3.6 million visitors to Singapore, just 1 year. Okay, the second most is Indonesia. But in this year, first half, 2023, January to June, you'll notice that Indonesians, yes, they are the top, but the mainland China side is not the top, only 424,000. So they are not coming to a level of being the top, which used to be, okay, for Singapore. And for Indonesia, 1.1 million is quite close to the amount of travelers coming in Singapore in year 2019 for the first half. So there are still room for improvement in that sense, okay, room for travelers to come. But the key thing I want to point out is that mainland China has really opened their borders. But yet, at the same time, there is no full capacity, kind of having reached to a level of 2019. So over here, looking at this data, what it can imply is that we can expect more tourists to come in, especially in the second half of this year. So for me, Jay, I have been walking around, I have been observing the tourist area since January until now, walking around Gardens by the Bay and so on and so forth. I have noticed that really a lot of Indonesian, majority inside the Flower Dome and all this cloud forest, all these are generally Indonesians coming to Singapore, but I have yet to see Chinese coming into Singapore yet. Okay, very little, but really not a lot. So what I'm trying to say is that to expect more visitors, especially now China, they are revamping their entry permit, visa, and so on and so forth. But yet at the same time, it's also a transition period for the Chinese in China to be more willing to travel out of their country. Okay, so these are opportunities, these are things that I'm seeing that it could help us to decide what are the sectors that we should be invested in the second half, or probably even up to next year. Okay. Another, the sub-impact of growing tourism is definitely the retail industry. Okay, so on the 6th January, I have this report from the retail sales, very, very recent. But interestingly, it shows that retail sales has a dip in May. Okay, it has a 3-month streak of increasing, but the tourist numbers 4-month streak. But retail sales very interesting, only 3-month streak. Okay, and the biggest change, the biggest contributor actually usually come from food and alcohol because of tourists and stuff. But it seems that there's no change month to month. Okay, very interesting. There's only this very specific month of the month of June, not so much tourists. Okay, but the biggest contributor, the biggest dragger is actually cosmetic, toiletries and medical good. Okay, it has been also the second best contributor, but it has been coming down a little bit itself. But the biggest contributor is actually the optical goods and books. But over this information that I received, I say, hey, how come? Very interesting. The retail sales has dipped when we see this word dip. But if you look at the exact numbers, actually dipped by 0.2% only, very little. It's not of a big concern unless there's a very big drop in numbers. Okay, and for food and beverages services, still positive. Okay, still positive, slightly higher. comparing the past. So that's where what I'm trying to say is that the retail businesses now is coming to be a bit flat like that. Okay, it's not continuing to grow, but I believe the stimulus still has to come from the tourism industry. So I'm really hoping that there will be more Chinese tourists coming in. When there's more Chinese tourists coming in, then this can definitely help to boost the economy upward further, which is expected second half of this year. And now I also want to talk about the draggers of the economic numbers. Singapore manufacturing numbers are still going down, not very good. Okay, and based on the latest numbers that I have is that in June, okay, 27, it's been reported that the manufacturing numbers will contract further in May. Okay, and recently there's a new number also coming in. It's still showing contraction, but it's not dropping as much as expected. Okay, so it's starting to slow down in terms of the contraction. So generally there's some signs. Okay, I don't have numbers over here to show you because it's really in the past few days only. That the market manufacturing numbers are slowing down, yes, but it's not going slow down further. Instead, it's also starting to flatten. Okay, so in starting to flatten, this also can show a possibility or a sign that the risk of manufacturing sector to contract further is going to get lower. Another sign that another thing that we can look at to decide whether the manufacturing are still doing well is about looking at export figures. Okay, so generally when we look at export figures, it can also give us a sign that whatever things are being manufactured in Singapore is not just for local consumption, but it's also to produce for overseas consumption. So for overseas consumption, that's where export numbers will show how much the manufacturing sector can benefit. So that's why I also keep track of the export figures, and export figures has been reported more recently also on the 18 July. You see around this time period, 16, 17, 18 July, all reporting this kind of numbers. So the export numbers is quite clear that the export is stumping again. Okay, it's not doing well. Okay, but you see experts are cautious on recovery. They are cautious on recovery. What does it mean? It means that they don't expect recovery so much. Okay, but what I'm seeing over here is I want to focus on the electronics because I'm looking at the manufacturing sectors. I want to know roughly the manufacturing sector, are they going to go down further? Because if they're going to go down further, they are going to drag the GDP numbers down. But if they are not, they are showing signs that they're not going to drop further, and yet at the same time, I'm expecting the tourism numbers to be going up, then we shouldn't be seeing the GDP numbers to be worsening. Okay, it should be either flat or it may even show a certain level of growth. So when I look at the electronics export figures, it's interesting to see that from May to June, the line, okay, is starting to point upwards. Yes, the export has been year on year dropping, but it is starting to improve. Okay, there are signs of improvement. So when there are signs of improvement, this can also trigger a possibility of bottoming in the export numbers for electronic sectors. So it's a very positive sign. Okay, it's some positive sign that I can expect that maybe the electronic manufacturing sector may not be so bad, it may not contract further, because my main concern is that it can contract further. If it contract further, this can drag the whole Singapore economy down. So that is some little bit of good news. So when there's some little bit of good news, it can give me some positive insight, especially for this second half of this year. Okay, we should also start to trigger for me to look at sectors, electronic manufacturing sector. What are the individual companies that I can start looking at? But I need to ask myself whether I can undertake this risk before I start looking to invest in such sector. So the last information I'm going to share with you is about inflation rate. Okay, yesterday just came out a new inflation rate data, but I got not enough time to really draft out the figures for you all to see. Okay, so based on the previous inflation data that is being reported on the 23rd June, okay, is that the inflation numbers is easing. Okay, so based on this report in June, the core inflation is easing to 4.7%. In fact, based on today, what I read is around 4 point something percent. It has reduced further. Reduce further means that the inflation rate of Singapore is now well controlled, well managed. So it's well controlled and well managed. What does it mean? It means that we are not going to expect further strengthening of Sing dollar. We are not going to expect that inflation prices in Singapore is going to be out of control. No. So meaning that whatever measures that MAS has done, the amount of losses MAS has incurred over early this year is worth it. Why? Because it has helped us to manage the inflationary pressures that is coming from overseas. But when inflation rate is coming down, this also means that when Singapore don't strengthen the Sing dollar, it's easier for Singapore to start exporting their goods and services. So this also gives a sign that maybe the manufacturing sector will not suffer more, because if our goods and services that are being exported out become more expensive because of strengthening in Sing dollar, then these kind of businesses may suffer more. So it's a good sign for me. Okay, it's a good sign for me that core inflation rate is coming down. It's not just on a personal consumption level, but also based on the business level, especially for business that are doing a lot of exporting work. Another concern about whether we are going into a recession is where we look into the employment numbers. Okay, so this is the employment numbers that came out in June about labor market in Singapore. Okay, so the job vacancy for Singapore labor market has fallen for four consecutive quarter. Okay, the fall of vacancy, it can signal a few things. First, when there's lesser job vacancy means that probably more people get employed, or their possibility is companies are employing lesser people, meaning they are tightening their employment numbers. Okay, so this one is a big question mark because Singapore employment numbers are usually very, very low one. Okay, but the question mark on whether the job vacancy is going to fall further is something that I want to look forward. But one interesting information that I have is that you see retrenchment numbers has increased until the first quarter. So what I'm waiting for is the second quarter, that means second half of 2023. If the retrenchment numbers continue to go higher in second half of 2023, then it will not become not a very good information or data. But based on all the information that I shared earlier on, there is a certain sense that we don't expect the economy to worsen. Okay, with the earlier information, we don't expect the economic numbers to worsen. And if we don't expect the economic numbers to worsen, what I can expect of in the job market or the labor market is that the retrenchment numbers should reduce at the second quarter of 2023. So if it reduces, it will send more positive sign that more or less Singapore could have already avoid the possibility of recession. Okay, so you see the tone and the manner I shared earlier on. There are more and more clearer signs that is showing that Singapore is going towards avoiding a technical recession or a recession per se. Things are looking more on the positive side. However, there are still some risks that over here. I cannot conclude 100% that second half of this year is going to be very, very good. No, there are still some risks. Definitely the risk is still on the manufacturing sector, and the export numbers, they are still slumping. They are still not doing well. but it really depends on the performance of the electronic manufacturing sector. So if the electronic manufacturing sectors are doing well, and the export numbers, some signs are showing the positive sign in terms of the electronic export figures. If all these are showing positive sign, especially in coming to third quarter of this year, then we can clearly conclude that such risk has reversed. Okay, and when it reverse means that it's reversing into opportunities for us. But of course, the general risk that always has been happening is actually the geopolitical uncertainty between US and China, and also the Russian-Ukraine war is still happening. It's still happening. That could trigger something that is unexpected. Actually, it's expected, but something that may affect the movement or the general sentiment of the market itself. But as you can see, there are also opportunities lah. You see, I shared that opportunities is very clear towards the tourism-related sectors. For example, accommodation, companies that deals with hotels, companies that REITs, especially REITs that do with hospitality form, okay, and even retail services, retail numbers show, though there's a slight slump, but it's actually not a big slump. Okay, it's only a 0.4% drop. But as long as the tourism industry are doing well, I believe the retail numbers will improve. So there are REITs that are towards the retail sector. There are also companies that are dealing with retail sector. So I will be looking at them. I have been looking at them, and definitely this will be a good sectors to look to invest in. But generally, the more greatest information that I have received is that the inflation rate of Singapore is improving. So when inflation is improving means that people are less worried. Okay, people are less worried about keeping their money to just in case inflation rate goes high. So when inflation rate is under control, probably people will spend more, people will invest more. So when such information, such positiveness come into market, such confidence come in, then that's where the stock market should also react accordingly. Okay, so especially when we can say that, hey, recession most likely going to be avoided. So once there's confirmation that recession is avoided, well, everybody will be going back into the market. So the key is that you see that what I'm trying to say is that in this year, second half of 2023, is really indeed an opportunity for us to restart our portfolio, meaning to start using our cash on hand, okay, money on hand, to start to look for investment opportunities in Singapore itself. So before I start to talk about how do we how do we prepare ourselves for second half of 2023, if you have any questions, please feel free to use the Q&A and ask me questions. Okay. Okay, so now with the likelihood that the market is really going to do well, with the likelihood that market is not going to really drop very drastically, meaning, or in other words, even if there is some downward movement, it's likely to be limited. And since it's limited, and since there's a possibility that things are improving, that's where we have to learn how to take some risk in the market. But there's still a certain level of risk. I cannot 100% confidently say that, oh, you must go into a market right now. What I can say is that if we take a risk right now, we can have good opportunities to see good result, not just in this second half of this year. We can see good result in coming year 2024 and beyond. Why? Because based on the general market trend or the movement in the market, you see that as long as the GDP numbers or economic numbers are staying on the positive side, it's not going down, we should be able to see the stock market prices to continue to go higher in future. So if we wait until the information that has been out, until we have clear confirmation that the economy is really doing well, by the time stock market prices could have already went up. So the best way is to prepare yourself to be able to undertake the risk. To be able to undertake a risk, you need to know what kind of stocks you are invested in. When you want to invest in a stock, the main problem with a lot of participants is that they are not confident with the company they are buying into. So it is important for you to understand what is the business, and important for you to understand the performance of individual companies that you are going to invest in. So this is where making investment work course comes in to train you on how to decide whether this company is worth for you to hold within this second half of this year or even beyond, to provide you a passive recurring income for you in the future. That's how you make investment work for you. So this is the main course, making investment course, that is accredited by IBF to help you to set a very strong foundation in choosing the right kind of shares. Later on, for those who have already attended making investment work course, you shall urge you to stay with me. I'm going to share with you how then you can go beyond this foundation of making investment work to be more precise, to give you further boost in understanding of what to invest in, what you have invested in. So let me spend a bit of time to explain, for those who are new, what making investment course is going to be like. First of all, making investment course is a comprehensive course which I need to break down the information into 3 different parts. In the first part, you will learn how to select individual stocks or individual company based on fundamental analysis. It is going to be a very practical session where you will learn how to read the financial annual reports on individual companies, how to understand the balance sheet, profit and loss statement, and even a cash flow statement. And through it, once you understand the company's operation and business, then we can make use of financial ratios to help us to decide what are the companies, in short, to filter out several hundred over companies in Singapore to decide which are companies that meet your investment objective. And it's going to be a hands-on practical session. Why? Because I'm going to provide you with hands-on template to learn, to practice on, to continue to practice on, not just in making investment course, but also throughout your whole lifetime. And this will be happening online, okay, on the 11th and 14th September, 2 months later, on Monday and Thursday night, 6:15 p.m. to 10:15 p.m., 4 hours per session for part 1. So at the finale, at the end of part 1, there will be a hands-on assessment, competency test that is required by IBF to help you to further enhance your understanding and make it more practical for you. And to help you to grow in your investment knowledge, I also provide homework on individual company to do at a pace at your own at home, because I want to train everyone that, hey, actually you can do it yourself without Jay around. And also some cybercode e-learning to reinforce whatever you learn in the first week itself. So at the start of part 2, I will go through the homework and clarify any thoughts on fundamental analysis so that I can move on to the next topic called timing the stock market. So to time the stock market, that's where technical analysis will come in. And in technical analysis, we're going to learn how to identify trend, support, and resistance. That is a classical type of technical analysis. But classical technical analysis is not enough. We need to use tools like candlestick and also technical indicators like moving average to further enhance our chart reading itself. So this is also very similar to part 1, where we're going to be a hands-on practical session where I'll provide you evaluation template on technical analysis for individual company. And in the same format, it's going to happen on Monday and Thursday night on the 18th and 21st September, 6:15 p.m. to 10:15 p.m. Concluding the part 2 with a competency test that is required by IBF to further solidify your knowledge on technical analysis practically. So in the same format, I also provide homework on technical analysis and also a cybercode e-learning module for you to go through at a pace of your time. So before part 3 happen, we will go through the homework to help you to clarify and to build a confidence in doing your technical analysis yourself. And in part 3, we are going to focus on learning how to manage your overall investment portfolio. And this will happen in one full day on Saturday, 23rd September, 9 to 6 p.m. Why? The reason is this. When you want to learn portfolio management, it's just not learning a tool or a kit, but it's a whole package. Whole package of what? A whole package of managing two things. First, to be a successful investor, you need to learn how to manage your emotions. So we'll start off with learning what is called behavioral finance, which is a topic that in the market not a lot of people talk about, but Jay is specialized in training this. And once we understand our behavior, then we are to set up portfolio management system, which includes how to decide how much shares to buy, how to diversify, how do I monitor my portfolio of shares, and how to decide when to sell for a profit or even to cut loss. So this is the whole package of just portfolio management system. Because very often in the course out there, people are just teaching you how to select stock, how to time the market, but they stop it down there. And I heard a lot of people, when they are wrong in positions, they are stuck down there and don't know what to do with it. So that's where portfolio management is the key and strongest part about making investment work, where I, Cybercode, also teach everyone to have a comprehensive way of managing their investment portfolio itself. So you see, this is the full package, not just only specifically on one small topic to learn one thing, but is to set a foundation to teach you how to combine and merge this whole thing to have a very specific and complete way of equity investment in the market itself. So this is the IBF accredited course. So there will be IBF funding, especially for Singapore citizens. And if you are above 40 years old, you'll be eligible up to 70%. And the remaining amount, you can use your Skill Futures credit to offset. And if you are Singapore PR or Singaporean less than 40 years old, you'll still be eligible for a 50% funding. And you still can use your Skill Futures credit to offset your sum. And also, I also like to share that the NTUC, if you are an NTUC member, and you can make use of NTUC with that funding to also to offset the remaining cost of this course. Okay, so if you are new, if you haven't attended making investment course, or in fact, if you have attended making investment course itself, you can actually re-attend, okay, because they have reset the whole thing. So I want to encourage you to think about signing up again, and I really hope to teach you and guide you in this coming September course to prepare for you for the market opportunities in the market. And if you really find that, hey, Jay, I really benefited from the making investment course that you have taught, and you want to learn more, that's where I want to introduce the all-new, never taught before, 2 hours financial workshops for you to attend. I have specifically crafted these 3 different specific modules to help you to understand certain important part or further or to help you to understand the company deeper or even the charts deeper itself. So these 3 modules are intrinsic value, finding intrinsic value, riding the Ichimoku cloud, and also using MACD to spot the turning points. So let me spend some time to elaborate and explain what do you learn in these 3 different 2-hour modules. First of all, finding intrinsic value of company. I created this course to help every individual, not just to use what you have learned in making investment calls, but to drive deeper to understanding the residual value of company, which is the intrinsic value. Many people have feedback to me, hey Jay, what do you mean by intrinsic value? Hey, can we find intrinsic value? I said, yes, we can look at the price to book value of a company, but price to book value has its limitation. There are a lot of other financial models, intrinsic valuation models out there, which also price in the nature of future earnings of company. Like for example, DCF model, discounted cash flow, dividend growth model, Benjamin Graham model, or even the well-known Warren Buffett model. So in this 2-hour session, I'm going to share with you all these 4 models, the pros and cons of each model, and practically use them to identify the intrinsic value of the company. So it's just only $199 before GST. It's something that will be helpful for you to understand, to deepen your educational level of finding the fundamental intrinsic value of the company. Next is the Ichimoku cloud. Ichimoku cloud, wow, I think a lot of y'all have first time heard about this term or this indicator. Now, Ichimoku cloud is a very interesting indicator that is invented by a Japanese. And like for me, I like Japanese candlestick. I use a lot of extensive on Japanese candlestick. But this Ichimoku cloud is also a very, very powerful indicator that can use. It has a lot of usage. It's also very versatile, not only to identify trend, but it can also help you to understand the price momentum. And the most interesting part about this Ichimoku cloud indicator is that it can automatically help you to identify the entry and exit level, meaning the support and important support and resistance level. So that's where I'm going to spend the 2 hours to teach you how to practically use this Ichimoku cloud to your advantage to read a chart momentum. So same price, $199 only before GST. Now, lastly, another most common use in technical indicators in the market, which is simple to understand, which is also as powerful, is the MACD indicator. For years, I've been using MACD, not just me, but also a lot of professionals in the market, they have been using MACD indicator to help them to identify market turning points, whether from downtrend going to uptrend. And with high accuracy in this reading, MACD proved to be a very efficient indicator to identify market turning point. So itself, you can look at the MACD lines to identify trends and even to identify possible reversal point. But the extension of MACD is the MACD histogram, where we can use it to complement the candlestick movement to confirm the bullish momentum in short term and the bearish momentum in short term itself. So MACD is another powerful indicator that can make use of, easy to understand, easy to learn, and also an indicator that a lot of professionals are using in the market. So I want to equip every individual to use this equipment firmly and itself. So same price, $199 only before GST. So these are the 3 different 2-hour workshop that I curated, especially to help, especially for my lawyer making investment graduates to self-improve, to learn more, and to enhance their investment strategy itself. So I want to encourage everyone to sign up now. And over here, you will see on the left-hand side is the foundation for making investment work. Then the 2-hour workshop on the right-hand side will be at different dates on the 26th October for the intrinsic value. And also for the Ichimoku cloud will be in a few weeks' time, 10 August, and also on the 24th August for the MACD indicator. So for sign-up details, I will let Andy spend some time to to share with you how you can sign up for this course. And to encourage everyone to sign up, I'm going to throw in another bonus. Okay, I'm going to throw you another bonus. The bonus is that as long as you sign up for any of the session, I will arrange my personal time with you for one-to-one private coaching. I definitely love to spend time with every individual to chit-chat and to understand your constraint. And once I understand constraint, I can share my personal expert opinion on how you can help yourself or how you can teach yourself or educate yourself to be a better investor in future. So this is really priceless. It's not just learning the information and knowledge. What I'm going to do is I'm going to encourage you and also to guide you, to mentor you to be a better investor who will know how to make investment work for you. So this is a bonus that is given to everyone and definitely is going to help you to be a much better investor. So before I pass the time to Andy to explain how to sign up for this course and to know how to sign up for this course, I'd like to thank everyone for spending the 1.5 hours with me. And I hope that the general market direction or the strategies that I'm going to look at in this second half of 2023 is going to help you to find market opportunities, especially in this period. When I talk about market opportunity, it means that we are not just preparing to see good returns in this year 2023, but it's also going to see good returns going forward in 2024 and beyond. What is more important is that I really hope that every individual will be able to make their investment work for them. So with this, I thank you for time and I will pass the time to Andy. Andy, please.
Hi, yes, Jay. Can you see me and hear me well?
Yes.
Okay, cool. Thank you very much, Jay. Our wealth manager. Well, we have a very fortunate to have Jay, a busy individual like himself who have been managing his client, as I mentioned in the beginning of the opening speech. You know, a lot of customers have been, engaged Jay to provide his marketing insight, and therefore he promoted to as a wealth manager, who taking of more than I think as of today, even increasing the AUM. Now, indeed, I would like to take this chance also to share to add on what Jay Chia, our wealth manager, just mentioned earlier on. Now, if you still remember, I think those who follow through CyberCool courses who jolly well know, right? Who jolly well know very well, right? I believe quite a fair bit of you have been following through our courses, you know well about that. Now, in fact, Making Investment Work course is the very first pioneer course accredited by IBF, even right before accredited by IBF. And those years, we're talking about easily more than 6 years and above, right? 5-6 years and above before we get IBF accredited. Now, those participants who sign in for this course, the same course that you're learning today, the Making Investment Work course, you got to pay from your pocket money to attend all the session. I mean that time the course fee, the training hour is shorter, is 1,500. Now, imagine that years before the IBF get this, before this Making Investment Work course get accredited by IBF, participant, you got to pay full course fee from your wallet or from your purse, from your bank, to join in to learn from JHR from this Making Investment Work course. So that is something that I would like to really to take this chance. And also a lot of things today has been thrown in by Jay, you know, especially the personal coaching session. Now, if you ask me, you know, you're paying a 199 with the GST, let's say, I think it should be 216, right? With the fee that you're paying, right? Actually, the fee of the 199 is, or I think maybe is still like slightly below of the coaching session. I think if you go and check around in the market, personal coaching session, one session may cost easily $300 and above for the day, because it's a one-on-one coaching. You know, you don't have any other person besides you. That is something JJ, our wealth manager, who want to give this special for those who really sign up for today. Either you sign up for the Making Investment Work course, or whether you sign up for the modular class, the 2-hour session, whether it's the intrinsic value of company cost, writing the Ichimoku crowd indicator, or using the MACD to spot a market turning point. So in any of the either course that you sign up, you will be enjoying this personal coaching session. Now, also this, I would like to take this opportunity to just share with you. I would like to also in fact, I would say that, how should I put it? To let people know. Now, a lot of Singaporeans, you are aware that government give you the SkillsFuture credit, correct? Now, of course, we all know about that, right? If you're age 25 years and above, I mean, government will provide you a credit of, or let's say a $500 credit in your SkillsFuture credit account. Now, I think a lot of individual, I would say 90 to 95% of the citizens didn't know, not aware that the SkillsFuture credit is also come with the validity. It comes with the expiry date as well. So that is something that I would like to sign in. Would like to do the extra amount to share with all of you here. I would like to sign in my personal SkillsFuture credit account to run through with all of you here to let all of you know that whatever given by the government, the credit date is also come with the validity. It's just like our IBF course. Now, those who follow through our Cybercode Financial IBF accredited courses, you jolly well know, in the COVID year, that is about 2.5 years back in April of 2020, right? You still remember the circuit breaker case in. IBF provide up to 95% of the cost subsidy. So cost participant, you're age 40 years and above for citizen, you only pay 5% of the cost fee. And then the following year in 2021, they dropped to 90%. And then following year, which is last year, 1st Jan 2020, they dropped to 70% up till today. See the trajectory, it keeps dropping and dropping in terms of the subsidy. And I mean, if you do ask me, you ask me, you ask my personal view,